Everybody would love to pay zero in taxes, but most think you have to do something shady to make it happen. Offshore accounts, crypto wallets buried in your backyard, sketchy accountants. Well, no, not exactly. What I'm gonna show you is 100% legal and actually pretty simple in theory. Canada taxes based on residency, not citizenship. So if you cut ties and become a non-resident, you can stop paying Canadian taxes on your global income. But here's the catch. While the concept is simple, doing it right is anything but. It's complicated, easy to mess up, and if you get it wrong, just like John Wick, the CRA will come after you and they won't stop until you pay. In this video, I'll walk you through the 7 steps to legally cease Canadian tax residency, plus 3 top countries with sunny beaches and year-round warmth that Canadians can move to and pay zero in taxes. First, let's understand Canadian tax residency. If you plan to relocate to a country with zero personal income tax, your first and most important move is to legally end your Canadian tax residency. Canada taxes individuals on their worldwide income only while they're considered residents. And no, simply moving to Bali with your yoga mat won't end your tax residency. Leaving the country isn't enough. You must sever your residential ties and properly notify the Canada Revenue Agency. To me, this is actually one of the many great things about being Canadian. Unlike the United States, where citizens are taxed no matter where in the world they live, Canadians can make a clean break. Once you leave and follow the rules, you're no longer on the hook for Canadian taxes. It's a privilege and a reminder that we're not just living in America's shadow, we play by different rules and oftentimes better ones. But be warned, the CRA can act like a jealous ex by stalking your border crossings, checking your accounts, and watching for any signs that you're still hung up on Canada. Here are the 7 key steps to follow that we help a lot of our clients with to cut the CRA out of your life completely. Step 1 is to sever your primary ties. The CRA looks first at your primary residential ties, including ownership or rental of a home in Canada and having a spouse or dependent children remaining in Canada. To end your tax residency, consider selling or renting out your Canadian home and move your spouse and dependents abroad if that's applicable. Keeping a home or family in Canada signals ongoing residency. Step number 2 is to reduce or eliminate secondary ties. Secondary residential ties can also indicate residency. These include Canadian health coverage, Canadian driver's license or provincial ID, bank accounts and credit cards, club or professional memberships, and more. You can check out the full list here. While not all secondary ties must be eliminated, the fewer you maintain, the stronger your case for non-residency. Step 3 is to establish residency in another country. To demonstrate a true change of residence, establish strong ties in your new country. So you can lease or purchase a home, obtain a residential visa or permit, register for local services like utilities, healthcare, tax systems, and most importantly, spend the majority of the year there, ideally over 183 days. This is especially important if your new country doesn't have a tax treaty with Canada, such as the UAE or most Caribbean nations. Step 4 is to file your departure tax return. In the year you leave Canada, file a final tax return and indicate your departure date. This is referred to as a departure return, and it applies Canadian tax to your worldwide income up to the departure date and declares your new status as a non-resident. It also triggers the CRA to treat you as a non-resident for the following year. And after departure, you are only taxed on Canadian sourced income, typically through non-resident withholding tax. Step number 5, understand and prepare for departure tax. Canada imposes a deemed disposition of certain assets when you seize residency. That means you're considered to have sold most capital assets at fair market value, which may trigger capital gains tax. The tax applies to things like non-registered investments such as stocks, crypto, or collectibles. There's also private business shares, foreign investment property, and it excludes assets such as Canadian real estate and excludes things like RSPs, RIFs, and TFSAs. These are taxed later though upon withdrawal or sale, potentially, and I get into this in more detail in another video. You may need to file things like Form T1161, which is a list of your properties, or Form T143, which lists your deemed dispositions. And if your tax owing is high, you can ask the CRA for payment arrangements or provide security. Step number 6 is to decide whether to file Form NR73. This form allows you to request an official ruling on your residency status. However, this is not mandatory, and many accountants will recommend against it unless your situation is very unclear or you expect to be challenged in the future. If you've clearly ended your ties and established yourself abroad, simply completing your departure return is usually enough. And step number 7 is to wrap up loose ends. To fully close the chapter with Canada, there are still a few final but important things to handle. You have to notify your banks, brokerages, and investment firms that you're now a non-resident. This affects how they report your income and which withholding taxes apply. Update all your mailing addresses to your new country so nothing slips through the cracks. And cancel or convert any provincial health coverage, and review your insurance policies. Many don't work once you've left the country. You can also request a CRA compliance certificate called as T2062 if you're disposing of taxable Canadian property, though it's optional in most cases. Now, these 7 steps are quite simplified. If you have a corporation, foreign assets, trusts, or a more complex setup, your situation may involve a lot more steps. And here's a pro tip: we highly recommend getting professional help with the accounting part of this. If you mess it up, the CRA can hit you with penalties, interests, or even decide you never actually left. And at Blueprint Financial, we've helped many Canadians get it right and stay on side with our Exit Canada planning. So check out our services if you're serious about leaving. Now let's go over a few popular countries that you can live in that have 0 taxes. The first is Dubai, or the UAE. Imagine waking up to sunshine nearly every day of the year and sipping coffee with a view of the Burj Khalifa, and knowing that your global income isn't being taxed by Canada. That's the appeal of Dubai. Dubai has become one of the most popular zero-tax destinations for Canadians, particularly for entrepreneurs, online business owners, and high-income earners. The UAE imposes no personal income tax, no capital gains tax, and no tax on dividends or crypto for individuals. In 2023, though, the UAE introduced a federal corporate tax of 9%, but this only applies to business profits exceeding 375,000 AED, which is approximately $136,000 Canadian per year. Many free zone companies are still eligible for a 0% corporate rate on qualifying income. Residency options for Canadians. First, you have your free zone company setup. Setting up a business in a free zone grants a 2 to 3 year residency visa. Costs typically range from 20 to 60,000 AED, which is approximately 7 to 22,000 Canadian dollars, depending on the free zone and business type. Then you have your remote work visa. Dubai offers a virtual working program for remote employees and business owners. Applicants must earn at least $3,500 USD a month, show proof of employment or ownership, and provide health insurance. And the third way is a property investment visa. Investing a minimum of 750,000 AED, which is approximately $275,000 Canadian in Dubai real estate, can potentially qualify you for residency. And at least 50% of the property value must be paid off if using a mortgage. Here's a summary of Dubai. Now let's take a look at something closer to home, which is the Bahamas. If your dream location involves turquoise waters, white sand beaches, and sipping rum with your feet in the ocean, all without paying a dime in income tax, the Bahamas might be your paradise. It's renowned for its tax-friendly environment, and it imposes no personal income tax, no capital gains tax, no inheritance tax, and no corporate income tax. Instead, the government generates revenue through consumption taxes, property taxes, import duties, and business license fees. Some residency options for Canadians are economic permanent residency, called EPR. So you can apply for EPR by investing a minimum of 1 million USD in real estate or other approved investments. This status allows for permanent residence in the Bahamas. The second way is annual residence permit. For those not meeting the EPR investment threshold, an annual residence permit is available. Applicants must demonstrate sufficient financial means to support themselves and their dependents. Some key considerations, though, are the cost of living. The Bahamas has a relatively high cost of living with expensive real estate and imported goods. While medical care is available, complex needs may require travel to the US or back to Canada. So here's a summary of the Bahamas. The third country is the Cayman Islands. If you're after luxury island life with zero income tax and modern comforts, the Cayman Islands deliver it in style. Think beachfront condos, crystal clear waters, and upscale dining. It offers a highly favorable tax environment, again with no personal income tax, no corporate tax, no capital gains tax, no payroll tax, and no wealth tax. This makes it an attractive destination for Canadians aiming to eliminate taxes while enjoying a high standard of living. So some residency options for Canadians is number one, a certificate of permanent residence for persons of independent means. This option requires an investment of at least $2.4 million in USD in developed real estate. Applicants must also demonstrate the ability to support themselves without the need for employment. The second way is a 25-year residency certificate. By investing 1.2 million US in local real estate, you can qualify for this certificate. This allows you the right to reside in the Cayman Islands, but you won't have the right to work. Some key considerations though is for the cost of living. The Cayman Islands have a very high cost of living with expensive real estate and goods. However, they offer modern infrastructure, low crime rates, and high quality healthcare and education. So here are the Cayman Islands at a glance. So an important note I want to point out here, your options for countries that have zero personal income taxes are quite limited. But you can also choose some very low tax countries to live in to dramatically reduce your bill. Even if you don't bring your tax rate down to zero, becoming a non-resident of Canada opens up a world of opportunities to pay far less than you would have than staying put. And that's exactly what we love helping Canadians do here at Blueprint Financial. From managing your tax filings and compliance and Canadian investments to navigating tax rules and avoiding costly penalties, it's not just about leaving, it's about staying smart. We help guide Canadians through every step of that journey. If you're thinking seriously about making this move work long term, visit our website to see our services. And if this video helped, give it a like and subscribe. And YouTube's picked out this other video it thinks you'll find helpful, so go ahead and check it out.